Hey, so today we want to talk about share buybacks, or sometimes known as share repurchases. Before I jump in, as always, if you are interested in the idea of learning about financial markets, trading, investing, or overall economies, please hit the subscribe button. We really appreciate it and would love to keep pushing out great content to everybody here. So let's jump right in. The idea of a share buyback is when a company goes to the public markets and purchases their own shares to bring them back in-house. There's a lot of reasons why they would do this. There's times when they would do this, and there's a perspective from it in the investor piece, as well as sort of the overall economic view of good or bad here. We'll take this piece by piece as we go through the video. But let's start with a really good baseline of understanding how this works. A share buyback is always going to be done after a company has gone public. So the idea here is that when a company moves from being from privately owned by investors or owners or whatever the case may be, they then release a public offering in the form sometimes of an IPO, a direct listing like a DPO, or sometimes they can even merge with other public companies. Those details aren't too important for the sake of what a share buyback is, but it's important to understand that these are companies that are going to be typically publicly traded with shares that are accessible on open and public stock markets. So really the basics of this are simple. A company decides that they have a large amount of cash on hand perhaps, and they want to go and bring some of those shares that are in the public back in-house. And you might say to yourself, well, why would they do this? This doesn't necessarily make a lot of sense. They could use that cash to better invest in research and development, or potentially acquire a new company, or potentially, pay down debts, or any number of things they could do. The idea behind it is they see an opportunity within the marketplace to increase shareholder value via these buybacks. And there's a really specific and easy way to look at this. One of the key things we look at from an investor perspective is this idea of earnings per share. So, as you can imagine, it's simple math. We look at the earnings divided by number of shares in the market. As they pull more of those shares out of the public market and back sort of into their, we'll call it like the safe of shares in-house, those EPS numbers are going to naturally go up because it might be the same earnings, but divided by even less shares. This in turn has an effect of creating sort of a value situation for an investor or their public shareholders, where now that EPS goes up, and with it typically, and again, nothing's ever always typical or 100% guaranteed, but typically what you'll see is share prices then go up after buybacks because with less shares in the market, the company's still being worth the same in theory, those shares should go up in tune to keep that market cap where it is. Now, one other thing to look at is when do they typically do this? Companies will typically look to do share buybacks when they're sitting on large piles of cash and they don't see a better investment for that money. And this will get into a second here of what the perspective is from the public and from other folks within the media or sort of regulators' view as well. Does this make sense? Is it the best use of the money or not? And we'll talk about that in just a second. Now, you might wonder, if you're sitting on a huge pile of cash, there seems like there should be a lot of great things to do. But you have to remember, one of the big things for any public company is to put the shareholder needs really front and foremost. Now, you may not believe that that's the right thing to do, and maybe it isn't. I'm not commenting on that today. But that is a big piece of it, is to understand that your job as a corporation in the public market is to do right by your shareholders. And typically boards or executives might see this as being the best thing they can do right now to increase shareholder value. Now let's jump from the investor perspective of this. If I'm an owner in company XYZ and I see that they're going to be doing a large program of share buybacks, and typically we're talking hundreds of millions, if not billions of dollars of buybacks here. And that's important to note as well, that these are typically known in advance, board level decisions that are released publicly. So there shouldn't be any surprises. There should be no buybacks that you're not aware of. So if you're interested in looking at companies that are going to be doing buybacks, it's pretty easy to find that information. They're going to release it publicly. You can then make the decision as an investor if you believe that because of that share buyback program, that share price will go up or not. And that can be a great way to think about where you want to invest your money in the near term, or potentially even long term if you see a lot of value down the road. Now, the other perspective, of course, from sort of the market commentary or the regulators, or especially sometimes from the government, especially on the Democratic side of things as well, is there's generally a message around the idea that, is that really the best thing to be doing with the money? Couldn't you be reinvesting it, raising employee salaries perhaps, right? Perhaps you could buy and acquire more companies, pay down the debt as we mentioned earlier, really focusing on R&D and expansion opportunities, or maybe just sit on the cash for a better opportunity to do something with it. And these are things where, as an investor, it's important to understand that there's a lot more that goes into where you put your money or where you invest it than just the obvious dollars and cents in math. You want to make sure what the full picture looks like. So if you're hearing a lot about share buybacks and they're in companies that you own or in companies that you potentially think you want to own, make sure you understand the entire picture of what they're doing. They're going to pay cash to buy shares on the market to bring them out of the public market. This in theory should increase the EPS, as one would imagine. However, we want to know, is this really the best thing they could be doing with the cash on hand? Will it really give me long-term results on my investment in this company? And then also, what can happen from a sort of, I don't want to say media, but almost like a perspective from the general public on these companies when they do it. When they do it and things are great and we're in a bull market, everything's great. But as we're recently learning in 2020 here, for airline companies in particular that did heavy share buyback programs, they're sitting on no cash now and are getting just pummeled in the public markets. There's a lot of anger and a lot of folks who are questioning, well, why the heck weren't you prepared for a downslide of market price and demand? And these are just all things as a good investor you should know going into every investment that you're making, that it's not just a question of, is the price going to go up or go down? It's a question of, what is the company doing to make that happen? What is the public view of that? Is it the best thing they should be doing today? And this is all part of the research you should do as you sort of go through your strategic planning, your tactical planning as far as where to put your money. So that's it. We'll keep it pretty short. I really appreciate you listening in, and have a good one. Thanks.